Retirement is around the corner, maybe just 2 or 5 years away, and now it's time to get your ducks in a row. It might seem like the closer you get to retirement, the more you need to save. But in reality, for many, those last few years don't move the needle as much as you would think. So let's look at some smarter steps you can take to set yourself up for a successful retirement. These next few years might be some of the best years of your life. Even if you're still working, you can potentially enjoy yourself while you get strategic. Here's a question that might surprise you. Can you just stop saving money once you're within a few years of retirement? For a lot of the people I work with, the last 2 years or so of savings don't really move the needle when it comes to their retirement readiness. Even if you max out your 401ks and IRAs, it might not make a big difference. If you stop adding to your retirement accounts, you'll have more cash flow and you can use that money on all the things you want. If you were waiting until retirement to take vacations, then you can use that extra money for more travel or fun or whatever else it is that's important to you. That makes those last few working years more enjoyable because you'll come back refreshed and energized and fulfilled. At the same time, you're leaving your savings intact while you work, and the longer you do that, the more powerful it is. Obviously, if you need more money or if you want to be really safe, then yeah, you should keep on saving money. Every dollar helps. But a lot of people can make it work without any additional savings during those last few years. What's probably most important is that you keep working during those years. And again, this assumes that you need to keep working and you don't have enough to retire just yet. The alternative is to stop earning income altogether, and that will mean you have to start drawing on your assets heavily. Once you start that process, it has a much bigger impact on your account balances than a few more years of contributions. Next, let's talk about an income plan. Once you stop getting a paycheck, you'll need a strategy for taking income. Do you know what your income will look like year by year? Figuring that out can help you strategize. The first step is to pick an approach. Are you going to stop working entirely, or will you taper back or maybe take a part-time job for a few years before you fully retire? Those more gradual strategies can often make a retirement plan look a lot better. Next, figure out when you will take Social Security or pension income. This doesn't have to be at the same time as when you stop working. You can separate those two. In many cases, it makes sense to spend down some assets before you start taking income. That's especially true if you have a lot of money saved in pre-tax retirement accounts. By delaying with a Social Security bridge strategy, you can manage your taxes while maximizing your Social Security income. The result might be less lifetime spending on taxes, lower Medicare premiums, and might have other benefits. And by maximizing your Social Security, you get more income that's government guaranteed, inflation adjusted, and tax favored. That's especially helpful if a spouse might take over your benefit after your death. I've got other videos that dive into those details, so keep an eye out. Now, where should you draw income from? Choosing which account to spend from is a critical part of any income plan. You might have money in pre-tax or traditional IRAs and 401ks. You might have Roth-type money, might have taxable brokerage accounts, and more. So where do you pull from first? Tax planning can help you answer that question, and it depends on your needs and the makeup of your accounts, how much is in each category. Don't just listen to conventional wisdom or rules of thumb. Instead, evaluate how you can get money out in the most tax-friendly way while setting yourself up and your heirs, if that's important to you, in the best way possible. You'll often hear people say that you should spend down those taxable accounts first, then exhaust your pre-tax retirement accounts, and then finally move on to your Roth-type accounts. But that doesn't always make sense. You might be better off drawing down those pre-tax balances first, so make a plan and find out. Keep in mind that you can also convert money from pre-tax accounts over to Roth accounts, strategically paying taxes when it makes the most sense. For example, you might convert a modest amount each year, just up to a tax bracket or an IRMA level, for example, to chip away at your pre-tax account balances. Meanwhile, if you pay the taxes on those conversions out of your taxable accounts, like bank accounts or brokerage accounts, then you'll maximize the amount that actually ends up in your Roth accounts. Plus, you'll get rid of some taxable assets at the same time. That might lead to less dividend and interest income on your tax returns. There's a lot to learn about taxes, and I've got other videos that'll help you figure that out. If you're finding this video helpful, please leave a quick thumbs up to let me know. Now let's talk investment risk. If you plan to stop working within a few years, you're in the retirement red zone. The technical term is sequence of returns risk, which means that if there's a big market downturn early in retirement, that can cause problems later. If you're taking large withdrawals while your portfolio is down sharply, then every withdrawal takes a bigger bite out of your total assets. When that happens, withdrawals that might have made sense under more normal conditions can end up causing you to run out of money early. So review your investment strategy regularly, especially as you approach retirement. If you're day trading or picking individual stocks, or if you have 100% of your money in stocks, then just think about whether or not that's what you still want. I can't tell you what to do here because I can't predict the future, but I would encourage you to explore the pros and cons of different high-risk strategies. And ask yourself, do I really need to be taking this much risk? Does my plan require that I pursue big gains? Would I sleep better if I did things differently? At the same time, remember that avoiding risk altogether might not be the right strategy. If you just keep everything in cash, then inflation could eat away at your purchasing power over time. So it could make sense to have exposure to some assets that you expect to grow, but the question is always how much. Now, it might also make sense to build up some cash reserves as you approach that retirement date. Having at least 1 year of withdrawals in safe assets like cash could help you mitigate that sequence of returns risk that we talked about a minute ago. When markets crash, you can draw from your cash reserves instead of selling investments at a loss, at least for a while. Again, there's always that question of how much cash should you hold? That depends on your plan, but I would mention that you want to focus just on withdrawals or the amount you're going to take out of your portfolio each year as you figure that out. If you have income from Social Security or a pension, that can help to reduce the amount you need in cash, because you don't need to fund 100% of your spending out of the portfolio. So if you need $80,000 per year, but you get $30,000 of Social Security, then you really only need $50,000 per year plus taxes that comes out of the portfolio. Keep in mind that that cash doesn't need to be in a bank account. You can keep cash or similar vehicles in accounts like 401ks, IRAs, the TSP, etc. Now let's talk debt. This is a good time to make a plan for any debts you may have. Whether you have a mortgage or some credit cards, you have to figure out how you're going to handle all that. It's really best to eliminate all high interest rate debts like credit cards before you stop working. Those loans have a way of growing if you don't address them, and they can really get away from you. And by getting rid of those debts, you're freeing up more of your retirement income for what really matters, whether that's travel or hobbies or just having less financial stress. When it comes to your home loan, I think you have some options. Some people are adamant about being debt-free before you retire, and nothing wrong with that. Other people are ready to retire, but they still have a loan, and they can afford to make the payments whether they're working or not. In those cases, it might be fine for them to retire and pay the mortgage out of their retirement assets and retirement income. But it's critical to run some numbers here. Just triple check that you can keep making those payments, especially if some sort of surprise happens. And remember that as you pay off debts, your expenses will drop somewhat. A lot of people miss that fact. As a result, they plan on unrealistically high expenses for the rest of their lives. But the principal and interest portion of your mortgage payment could go away at some point. You'll still have taxes and insurance and other housing costs, but things should improve a little bit if that loan is gone. And people always ask if they should cash out their retirement accounts to pay off a mortgage before they retire. That depends on several factors, and it's important to be mindful of taxes if you're looking at making a big withdrawal. If that money is in a pre-tax retirement account, then the entire amount could go on your tax return as ordinary income if you take it all out in 1 year. That could cause you to pay a high tax rate on the amount you withdraw. It could affect your Medicare premiums and more. So be careful if you're considering this and explore a variety of different strategies. One of them might be taking out smaller chunks over several years so that all of that doesn't go on your tax return in 1 year. Now let's talk healthcare. Start learning about how you'll get healthcare in retirement and how much it costs before and after Medicare starts. And you'll also want to know what exactly is and isn't covered by Medicare. You might be surprised, and it's important to look at things like dental and vision and long-term care and more. You'll want to speak with an insurance agent several months before you turn age 65 at least, if not more than that, and go into those meetings with some advanced education. Most people get some additional coverage on top of Medicare Part A and B, and that typically comes in the form of either Medicare Advantage or Medigap, also known as a supplement. Medicare Advantage tends to have the lowest premiums, but sometimes you end up getting what you pay for. Your options might be limited, you might need to get prior authorizations, and you may end up having to pay a lot if you need substantial amounts of care. Medicare Supplements, or Medigap, tends to have a higher monthly premium, but you tend to have more care providers to choose from and a little more certainty on how things are going to go. Next, let's talk long-term care. Most people assume that Medicare will cover long-term care if they need it. Unfortunately, that's not the case. Medicare is for medical expenses, but it does not cover custodial care. Custodial care refers to basic living tasks like cooking and cleaning and getting around and more. If your body doesn't allow you to do those things, or if cognitive decline interferes, then you're gonna need help. So it's really important to make a plan for that time in your life. A good plan has at least two parts. Number one, how and where will you get the care you need? And number two, how will you pay for any services you need? A lot of people simply focus on the question of long-term care insurance when they think about this. Should I buy it or not? That's part of the puzzle, but you also need to think about arranging care, preferably a long time before you actually need it. Plus, there are multiple ways to pay for care, and I've got a video out there that covers 5 options for you to explore. Next, run some numbers. If you do some retirement planning and calculations now, that means fewer surprises down the road. You won't predict things perfectly, but you might get some clarity, you might have the confidence to actually stop working, and you might identify a few tweaks you can make to improve things. Start figuring out how much you can spend and what strategies make the most sense. Analyze when to take Social Security and run some what-if scenarios with, let's say, optimistic and pessimistic investment returns and different inflation scenarios. There are a lot of tools out there to help you do that, or you can check my website to see some pricing and options. All right, I hope you found that helpful. Thanks for watching, and I'll see you in the next video.